Hello, I'm Nora Hanna, Chief Engagement Officer at Sun Health, and I'd like to welcome you to this episode of Coffee Connections. We created this series to bring you the most current and relevant information on topics that matter most to you as you do critical planning for your future, and to connect you with the preeminent subject matter experts so that you can make highly informed decisions that are right for you. Our mission is to empower others to live longer, healthier, and more purposeful lives. So we're excited to be able to offer you this unique access to expert resources. Thank you for joining us and enjoy the presentation.
So, quick show of hands, how many people here have a will or a trust in place currently? Okay, so that's about 80% of you. That's good. So, why give? There's a lot of reasons to give. And I like this quote from Anne Frank. And there's a ton of, when I was preparing this, there's a ton of really good giving and charitable and gratitude quotes. And it just kind of goes to show the positivity and the sort of the good feelings that come with giving. And so a lot of this, there's the legal part that we're going to talk about. That's why I'm here. But a lot of this comes from you. It comes from inside, like what's important to you, where do you feel driven, where are your passions, and the legacy that you want to leave. So we're going to kind of touch on some of those things and really kind of hitting the dual impacts of charitable giving. And so when I say the dual impacts, and you have all these materials with you so you can take notes on them or take the packets with you, obviously. But when we talk about the dual impacts, what we mean is the part of you that feels good, the gratitude, the giving. I want to leave something to this organization that helped me, or this charity that I care about, and kind of feeding that piece of it. But then also what myself and Adam will talk to you about are the financial and tax advantages that can also come along with that. So there's the two dual benefits that come along with that. And whether, when we get into some of the more complex strategies, if your goals are, beyond just the simple, I want to be charitable, or I want to leave some of my legacy to this organization, we can talk about things that might help with retirement income, things that might help minimize estate taxes, or just, again, leaving a legacy for a loved one. But for almost everybody, you can align your goals onto one of these strategies. And really kind of and this is why I asked who here has already done some planning and has perhaps a last will and testament or a revocable living trust, because these are what I would call like the bread and butter or meat and potatoes kind of planning in estate planning. I think it's important for every adult to have a last will and testament and a revocable living trust, but they're also really easy ways to leave money to a charity, to take care of a charity or an organization in your plan. And beneficiary designations is another one that you can do that too. And really the way you do it is simple. Just like you leave assets to relatives or loved ones in your will and trust, you could do the same thing for a charity that you care about or you want to leave part of your legacy to. And there's a few different types of bequests. So these are legal terms or terms of art that you can do inside of a will or a trust. And if you have a will or a trust, it's very easy to amend those or create a new one. But there's what we call specific gifts or specific bequests, and that is, I'm leaving $10,000 to the Arizona Humane Society. I had a gentleman who passed away recently who we had helped years ago, and he had left $100,000 to 10 different charities. And so it was $10,000 to 10 charities, and that's kind of how he laid it out. But those are specific bequests. You can also do residuary bequests where you're, after you've made specific bequests, or if your plan doesn't have anything specific like that, you're just saying, hey, this percentage of my estate is going to this charity, or kind of carving it out that way. Or what a lot of people do is what's called a contingent bequest. I always like in my planning, and that's one of the things that I don't love about estate planning is I have to talk to people all day about bad scenarios and things that might happen and things that could go wrong. And we just have, like, I'm not doing my job right if I'm not talking to you about those things. And I always, every conversation, I apologize. I say, I'm sorry, we have to talk about this. But there are certain fluke scenarios that can happen. And one of those might be, what if everyone you've left money to, all your loved ones, you outlive? And so when you pass, everyone that you thought was getting your legacy is gone. So that's where contingent bequests can come in, and where a lot of people can provide for a charity in that way is through their contingent bequests and say, hey, if under this fluky scenario, not likely to happen, but if all of my loved ones predecease me, then I'm leaving it to these, to my church or these charities, and that's something that people can do as well. So, and then charitable charities or nonprofits as beneficiaries, also very easy to do. Everybody here, I'm sure, has or has had at one time a bank account, a retirement account, a life insurance policy, all of the above. All of those are very easy to just directly name a charity, and Adam might touch upon some of the tax benefits of some of that, especially with retirement accounts, in leaving those to charities. But it's very easy outside of your will or outside of your trust to just directly on these different types of accounts list or name a charity as the beneficiary, and then you've set that up for that account to go directly to that beneficiary. So along with the wills, a trust, the beneficiary designations, they're very easy, simple things to do. They're generally cost effective, very low maintenance. There's flexibility. A couple of the cons that are quickly worth mentioning is on a will, really on a lot of these, generally the gift is delayed until after you've passed. So it's not a lifetime gift. It's a gift that you're setting up for when you pass away. Beneficiary designations, you just have to be careful because those are married to the account you set it up with. So if that account closes and you open a new account, then you've got to be sure or remember to redesignate that beneficiary to connect it to that new account. So just thinking about those things as you move stuff around or update your finances. But for almost most people who want to do charitable giving, these are effective ways, a will, a trust, or beneficiary designations to successfully accomplish your goals and do so in a fairly cost-effective, easy, efficient way. So in terms of the timing, and I kind of alluded to this a second ago, a lot of it depends what you want to do. So we all get those things in the mail that ask for money, and there's certain ones that for me, I probably donate to a small percentage of them, but I donate to the things that I care about. And so of course they're still sending me things because they want more donations. But then I get all kinds of solicitations in the mail from different folks. So we all, in a way, we do some level of lifetime giving, even if it's not something that's complex. But from a timing standpoint, I just want to be clear or have you understand, take away from this, that bequests and wills and trusts, they only take effect after your passing. So of course there's no immediate benefit to the charity because it's still your money until you're gone. You've just sort of set up these instructions for how things are going to go. And there's no tax benefit either if that's part of the goals or part of the strategy you want to look to explore. And then we're going to talk about charitable trusts just very briefly. Again, we could spend probably 2 or 3 days legitimately talking about charitable trusts, but I'm going to spare you all of that. But what charitable trusts do is that it's a strategy. There's different charitable trusts. That's kind of like alphabet soup with the different trusts. But they allow you to provide some benefit or provide some benefit to you during your lifetime. Yeah, it can be a stream of income. Usually it can include a tax break, which Adam will, that's kind of his area. And you more immediately support the charity because you're giving them assets now during your lifetime versus when you pass. So a lot of where the strategy that fits for you, kind of where it's nuanced in here, is going to depend on what your goals are and what your situation is. But with charitable trusts, there's a couple different kinds, and some people may be familiar with these terms. Again, I'm going to go through these pretty quickly just in the interest of the time we have today. We do have some Q&A later, so if a question comes up, jot it down and we can if we have time, walk through it. But these are more complex tools that allow you to accomplish some goals of charitable giving. So really simply how it works is you take the asset, whether it's a financial account or piece of real estate, and you transfer it you set up a charitable remainder trust, and you transfer that asset to the trust. And then you, as the donor, receive income from that. So let's say it's a rental property, and I'll go through a quick example. You can put your rental property in the trust, and then you get some income from the property. And then after a period of time that's specified in the trust, the property passes to the charity. And the reason you do that is, it sets you up with some lifetime income, but also you get a tax deduction and avoid capital gains taxes that you might have based on what you purchased that property for versus what it's worth now when you're moving it into the charitable trust. But again, these are irrevocable trusts, so it's an irrevocable gift. It requires a little more labor to set it up, so the costs are higher with it. So typically this kind of planning is better for larger estates or the gift of significant things like a piece of property, a parcel of real estate, or a large financial account or something like that. And then closely related, like a sibling trust to the charitable remainder trust, is charitable lead trust, similar in the concept of setting up the trust and transferring the assets to it, but then the charity receives the income versus you as the donor receiving the income, and then your loved ones receive the property back to your heirs when you pass. And it's a mechanism to save on estate planning, but again, it allows you to support a charity that you care about now during your lifetime, and then reduce some of your estate taxes, but also seeing or feeling that benefit of that philanthropic impact, which again, most of us aren't ever going to see that benefit if we have just charities set up in our wills and trusts. So there's some benefit there too. Again, this is probably planning that's best suited for high net worth donations, as it does require a lot of setup and there's more labor involved in it. So here's just a quick, I want to walk through really quick example of a charitable remainder trust. So Mary is 70. She has $300,000 in appreciated stocks, which means she didn't pay $300,000 for them. She put in some amount of money to invest in them, and they've now grown, and thanks to the market, they're $300,000. So Mary, because she's on a fixed income, she wants some income and also is very involved in her local animal shelter. So she transfers her $300,000 in appreciated stocks to a charitable remainder unit trust. The unit trust sells the stocks, and they're going to go do their own financial planning with that money, but they've got this $300,000 pot of money that their job or their goal is to grow it as much as they can. They've agreed with Mary on a 5% unit trust amount, which means that she's going to get 5% of those trust assets for her lifetime or for some period of agreed upon time. So the benefit to that is their job's to grow the money, and the more the money grows, the more Mary's income is going to grow as well from that trust. So it's a nice benefit to her in that sense. So she'll get approximately $15,000 the first year, and then likely, depending on the market, her income's just going to continue to increase. And then once she passes, the remaining, all the assets just live with the animal shelter. That's a philanthropic donation. They can do whatever they want to continue their mission that Mary is supporting. So the reason this was good for Mary is it gave her lifetime income from the trust. She avoided any capital gains that she would have been hit with as she sold or otherwise transferred the $300,000 in stock. She got a partial tax deduction for creating the trust, and she not only left a meaningful legacy, but she got to see it at work too because she did it as a lifetime gift. And then quickly on the charitable lead trust, we have John and Linda, who's a retired couple in their mid-60s, and they have a $500,000 rental property. So they're going to set up a trust and move the rental property into the trust because they want to provide support to their church while eventually passing the rental property on to their children and trying to kind of pass along some tax break with it. So they move their property into the trust. The trust pays the church $20,000 a year for 20 years. That really adds up, obviously. And then after 20 years, the remaining assets, including any growth, meaning the value of that real estate at that time, is transferred to the children with no taxes. So it's complex, but it's some really big beneficial takeaways from this, because they were able to support their church with pretty substantial funds for 2 decades under this plan, and then also saved themselves, i.e. their children, some estate tax exposure as well. So kind of a win-win. But again, they had to be prepared to do this, and there was some work behind this, and they had to be ready to irrevocably convey this property to the trust. But it's just a tool in the toolbox to help kind of leave or design the legacy that you want to leave. So I wanted to just cover this real quick, that charitable remainder trusts, which we talked about, are ideal if you have appreciated assets worth $250,000 or more. So appreciated assets could be real estate, investments, et cetera, and especially beneficial for avoiding capital gains taxes on the sale of an appreciated asset. And then charitable lead trusts are probably best suited if you have an estate worth $1 million or more and are looking to avoid some estate tax exposure. So just kind of a cheat sheet. Donor advised funds, I think Adam's going to talk about these a little bit. This is just a fund that you can set up at a financial institution or through a public charity, and then you can donate money into it and then kind of specify how the monies are used, almost like small sort of grants. It's great because it's flexible. You can support multiple charities with it. There is some tax benefits on the capital gains assets that you move into it. And you can kind of make it a family thing, because you can engage the family and talk about, hey, how are we going to spread this money around? How do we want to recommend that these monies be used? So just a really quick one-sentence example. Susan donates $10,000 to a donor-advised fund, receives a small tax deduction from that, and then over 5 years, she's able to recommend $2,000 gifts to some of her favorite charities. So there's a little bit of benefit to doing this versus just giving cash on your own, because there is a little bit of tax benefit baked into this. And then charitable gift annuities, which is basically a contract with a charity where you donate assets and receive some fixed payments for life. So it's kind of like a simplified form of the charitable remainder trust minus kind of the transfer of real estate. So just jumping down to the example, John donates $10,000 to a gift annuity program at his alma mater, and then through their agreements on the annuity, he's basically going to receive $600 for life and a tax deduction on a portion of his gift. So it's a way to just sort of take some assets that might have some capital gains issues to them, give them to your charity, turn that into income for life. So there's kind of a litany of benefits there on that option. So the sort of the key takeaways I wanted to leave you with is that we covered, again, I jammed 3 days or maybe a law school semester into 15 or 20 minutes. This is just, there's a lot to mine here and really get into, but I just want everybody to understand that charitable giving is flexible. It can be very easy. Really, it's about what comes from you inside, your heart and your mind, what you want to do for charities or nonprofits, knowing that if you decide to be philanthropic with your own funds, there is a dual benefit often. I always recommend getting professional guidance. This is not something you want to probably do too much on your own. And then you can take simple actions today to make a lasting impact. So just start small. You could, if this speaks to you and you want to do something, I mean, you heard Nora talk about the good work that Sun Health is doing and how they're really kind of on a drive to be able to do more to care for people. If something like that speaks to you, you can start small and add a charity to your will or as a beneficiary designation. And usually I would say, is there any questions? But we're going to table those to the Q&A, so be sure to write them down. And that's it for me. I think we'll hear from Adam now. Thank you.
All right, let's see, this is, the only thing that matters on this disclaimer part is that I just kind of make up as many answers as I possibly can as best I know. I'll tell you if I know, I'll tell you if I don't know, and please check with your tax advisor before you take any action. Just as from a tax standpoint, just a quick run through on the basics of charitable contributions and mainly for individuals is what I was gonna focus on. So anytime we look at itemized deductions, we add all of those up and compare it against the standard deduction. The standard deduction for 2024 is around $29,000 for a married filing joint and around $30,000 for 2025. Figure that if you're head of household, it's around $20,000, and then single is about $15,000 or so. Once we hit 65, we've got a little bit of kicker, a little extra standard deduction. The itemized deductions are made up these days of medical expenses, which are only used if we have more than 7.5% of our gross income that's out-of-pocket expense. State and local tax, which is going to be sales tax, property tax, vehicle tags, that kind of thing. Mortgage interest, investment interest is sometimes overlooked, like your margin interest on brokerage accounts, and then charitable contributions. Gambling losses to some degree, but only if we have gambling winnings. So all of those itemized deductions are added in or put in one pile, and then it's compared against the standard deduction, and we take whichever one is larger. Generally, cash contributions are allowed up to 60% of your gross income as well. So here's a few different things to consider when we're doing it. So if we have some appreciated assets, stock, land, anything like that, then one thing to consider would be to actually give the asset to the charity instead of selling it and then giving the proceeds to the charity. We're going to get a deduction for the charitable contribution, and we avoid the capital gains tax. Another thing to consider, especially with the standard deduction being high, one thing, back up a little bit, the current tax law is going to expire at the end of 25. And so in 26, if nothing happens, then it's going to revert all the way back to what the rules were in 2017, which means lower standard deduction, exemptions come back, miscellaneous itemized deductions come back for employees, like tax rates go up. There's a bunch of capital gains go up. Bunch of things that will happen if we have to go back to the 2017. I don't think that we'll have all of. I think we'll keep a lot of the changes. That's just me. That's my personal opinion. But really, we don't know what capital gains are going to look like, what the standard deduction will look like, that kind of thing. So with the standard deduction being so high, bunching your charitable contributions in 1 year and then going and using the itemized, and then the next year don't have as many deductions into the standard, it's just kind of the wave thing. That's something else to consider. The donor advised fund is something it's something to consider. It's fairly simple, like Caleb was mentioning. And if you have the sale of a property or sale of some sort of capital gain, then we get a big deduction to offset. Maybe you sold your business, you have a big deduction to offset that larger income year. Making a contribution directly from your IRA to a charity, especially if you're 70.5 or older, is called a qualified charitable distribution. And so that will satisfy, once we have the RMDs, or the required minimum distribution, then the QCD, too many acronyms, the QCD will satisfy part of the RMD, and you don't get a charitable deduction, but you're probably going to use a standard anyway, so maybe you don't care too much. Something else to consider would be if you have a stock that is in a loss position, is to sell that stock, or maybe harvest it against some other gains to make that the gain subject to less tax, and then take that lost stock and contribute it to a charity. So at that point, we've created an itemized deduction and we've reduced our overall income. And then, like Caleb mentioned as well, the charitable trust with the CRTs, or the charitable lead trust. Non-cash contributions, generally if it's less than $500, we just put it on Schedule A, no big deal. Greater than $500 and less than $5,000, we just have to fill out the form and say we contributed household equipment or furniture, and it was worth X on the return. If we have a non-cash contribution that's greater than $5,000, then we get rid of all the stuff inside of the house or something. Unless we have an appraisal, we don't get any extra contribution amount over the $5,000. So $5,000 is kind of the max, and that would be for not only that house, but it's if you gave Goodwill earlier in the year, kind of a thing, it would be $5,000 max amongst all of the non-cash contributions. If you donate a public security, though, there's a spot on that form. We don't need an appraisal for it because it's publicly traded, so we know what that number is gonna be. For Arizona, we have a fairly low rate, 2.5%, and then Arizona has set up a lot of these credits that are available, and they change the amount every single year. But these credits are really good at reducing about $5,000 worth of state tax liability. They're even better because you're allowed to make those through April 15 of the following year. And so a lot of times we'll see, hey, I owe $2,000, and client will say, oh, I just want to send it to XYZ charity, kind of, or multiple charities. Then we put it on there. They make the payment by April 15, take the credit, and they're they've essentially told Arizona where they want their tax dollars to be paid. These contributions, they reduce the tax dollar for dollar, so it's just a straight credit. And when we think of the liability, we're not thinking of just the amount that's owed. We're thinking of the liability is actually before any payments, and before any credits, before any withholding payments, estimated payments. And so that's what the liability is. So if you do have withholding or estimated payments, then this is a way to reduce those and just have make the credit contributions by the time that you file. If there are any unused credits, then they roll forward up to about 5 years. Couple of things is that the credit is not able to be used in that itemized deduction bucket. It doesn't count. The IRS got rid of the double dipping in around August of 2020, if I remember right. And then the credit cannot be used if we take it from a qualified charitable. If we make the distribution from an IRA, it needs to come from the IRA into our checking account, and then from the checking account to the charity. So it's not gonna. It'll help with the RMD part, but it's not going to be able to be used as a qualified charitable distribution. The website there actually is a really good repository for all the different types of credits. Caleb talked on this pretty well. This again is a good. The donor advised fund is a good thing to consider when we have a very high income year. We can make that larger contribution. There's no requirement to make distributions or grants in future years, and so we can, the funds that are in there can continue to grow, and then eventually make additional grants as you feel. And then private foundations are going to be more involved as well. Similar to a donor advised fund, just more involved. There is an excise tax if you don't distribute enough of the investment income. All right, so a couple of scenarios here that I wanted to run through just to give quick examples of how this stuff will play out. So this is a fairly normal tax return. Interest income, dividend income, distributions, pension, capital gains, Social Security. We have a married couple. The assumption is that we have a married couple. Both are older than 70 and a half. The mortgage is paid off. We make $15,000 contributions each year. We have medical out of pocket of around $8,000, and state and local taxes of about $8,000. The medical out of pocket of $8,000, we can see that $8,000 divided by the adjusted gross income of $171 is less than 7.5%, so that 7.5%. So we're not going to get any credit for that medical on the federal. We do get some on the state return, but it's fairly minimal. And so if we have the AGI, or the adjusted gross income of 171, standard deduction with it being married couple greater than 65, then we have 32,000. So all told, we have Fed tax of 19 and Arizona tax of 2,200. By comparison, if we use $12,000 of our IRA distribution, and we do 15 overall, so of that 15, if we say that 12 is actually, the check is cut from the IRA folks directly to the charity of choice, then it reduces the income. the adjusted gross income, which can also help with the Medicare premiums if we're in that, if we're on the edge there. The adjusted gross income goes down, the overall tax goes down to $18,500 or so. And so, that simple, have the IRA people cut the check, reduces our tax by around $2,900. Different scenario, but similar. I increased the capital gain income to $30,000 in this. And magically, the capital gain income of $30,000 was exactly the amount of the proceeds that we gave to charity as well. And so the $30,000 of charitable and the $8,000 of state and local tax is $38,000, which is now greater than $32,000, which increases our item. It means that we're going to use the itemized deductions instead this time. And so 191, we can see the capital gain income is included in the AGI, so that increases it to 190. The itemized deductions go up to 38, and we pay total tax of around 23.5. By comparison, if we take that 30,000 and we donate it direct to the charity, then we reduce our income to 161. So that 30,000 comes out. The taxable income goes down. The itemized deductions, we can see the itemized deductions stayed the same at the same 38. The taxable income goes down, and so then the overall tax goes down to 18, which saves, give or take, $5,200. This assumes that we don't get the extra deduction on Arizona for the capital gain income and that kind of thing. It's just a very, very straightforward, boring type of scenario. I think that's all I got. There we go.
To learn more about Sun Health Foundation initiatives, become a donor, or attend a future Coffee Connections event live, please visit us online at sunhealthfoundation.org or call 623-471-8500. Sun Health, empowering people to live longer, healthier, and more purposeful lives.